So I'll start by introducing our panellists, I think. You've already met the first two gentlemen at the vanguard of Australia's, or the ASX's at least, manganese sulfate revolution. Justin and Brad. Justin, who we should point out, you've probably already seen this morning when you picked up your bag, because he ended up being our cover star for this month on the cover of Paydirt. Well done, Justin. Sorry, Brad, that I never made you cover star. Next to them is Brendan Ryan from Deterra Royalties, an enviable addition to our Battery Minerals Conference. And to the far left, although I assume not politically, is Daniel Rodriguez of CIU Group, whose colleague Linda gave such a fascinating presentation this morning. Thank you for joining us on this panel. We've had two panels that have overrun already this morning, and I'm assuming this one's going to overrun as well, because we're covering the entire financing of the critical mineral space in the next 32 minutes and 1 second. There's plenty to get through. Again, I'm sure lots of people have got questions and thoughts and ideas, so please raise your hand. I'm more than prepared to open up the floor in a few moments for questions. So please gather your ideas, and then the microphones will be wandering around in a little bit. I think we should really start at the most basic level. We've seen a lot of discussion about Inflation Reduction Act and the European Critical Raw Materials Act, and what the Australian government should be doing and what other governments should be doing to help fund critical minerals development, both at the mine gate here in Australia and downstream right across the world. I mean, is it in that context, is it fair to say, Daniel, I might start with you, in fact, is it fair to say that traditional debt and equity models of financing, resource financing in particular, are broken for the West's critical minerals ambitions? Are they enough to fulfill our ambitions in this regard?
Yeah, so thank you very much for the question. So as you know, CIU is a mineral economics company. We do look at helping companies in regards to BFSs, lenders reports, and so on. So we're pretty well exposed in this area. So as it comes to critical minerals, certainly what we've seen is, I think it's a few things. I think that traditional finance does have its challenges with critical minerals. Number one, because it's an extremely opaque market, for starters. So I think that when you're looking at, Western banks specifically, and the percentage of their portfolio that allows for that level of risk on not only the opaque market, but a price structure that is not as well developed as your typical bulk commodities or base metals like copper as an example. So it's more trying to either raise that level of risk within a traditional banking structure, and I think banks are really challenged with doing that, to be perfectly honest, because they don't have a risk profile, nor would their shareholders or customers want that as well. I think the challenge, certainly from a critical minerals perspective, is that typically we see agreements occur between two parties, and so there isn't an index price, which can then form a price formation or a forecast price that can then be bankable. And certainly what we do within CIU is we offer reliance. So when we are looking at lenders reports or finance reports, we need to ensure that the forecast price that we put forward is reliable from a bankable perspective. And in the critical minerals area, with these emerging minerals, it's quite challenging to provide that, again, when you don't have this opaque market. I think one other comment that I'll make in regards to this is from a traditional financing perspective, I think when you look at the cost structure of Western assets versus their Chinese counterparts, there's a lot of significant challenges there from a cost competitive perspective, and I think that certainly makes it very challenging when Western or traditional bank is looking at financing a project where the cost competitiveness is just not there. So yeah, that's a very broad overview, I think, for the challenges that we see in the, in this industry moving forward on the financing side.
Thanks, Daniel. Brendan, maybe you can give us, first of all, it's Deterra's first time at one of the Paydirt conferences anyway. Maybe you can give us a quick context of the company, but also if in your experience looking for opportunities, if you're experiencing the same problems that Daniel's describing for traditional providers.
Sure, thank you. TeraRoyalties, we're a newly spun out company from Maluka Resources. We have a market cap of about $2.5 billion thereabouts, and our main asset is a 1.232% revenue royalty over BHP's mining area C, so it's about 9% of global seaborne iron ore, which spins out about $200 million a year or more. From that, we're trying to embark on a company that sort of builds a diversified portfolio of royalty assets by helping companies fund new projects, and we're focused specifically on the bulk space and batteries, so we're not looking at precious metals. We think that's very well serviced as an alternate financing thing, so we think that there's a gap in the market for alternative financing with this instrument in another part of the industry. So the first part, why hasn't alternate financing moved into this sort of area more? I think there's focus, I think price, I think is a big one, and I think expertise. I think focus-wise, 90% of royalty companies globally focus on precious metals, and that's what they do. It's easy, it's sort of a well-trodden path, there's only one price deck to worry about, and you sort of get the reserve of resource expansion, and it's a fairly simple model. So, I think, in saying that, I think there is now, you've got Lithium Royalty Company moving into the, a specific lithium space, and you have different small, boutique sort of providers who are becoming subject matter experts in the commodities and starting to move into that, but that takes time. So I think the big thing, focus-wise, most people who've been lending money haven't had to lend to this industry. It's a fairly new and fairly opaque industry, as you say. So from a pricing perspective, I think if you look at trying to predict long-term lithium, cobalt, rare earths prices relative to iron ore and copper, in iron ore and copper, you sort of know demand is GDP plus or minus a little bit. And you look 20 years out, you know what that is. Supply is, the next 20 major projects that are coming online over the next 15 years. So on a relative basis, the understanding of the supply-demand dynamics is incredibly well understood relative to the battery metals, where it's incredibly volatile, and two, it's opaque. So getting a handle and accepting that risk, and what prices, how do you price that risk in terms of prices? And the last one is expertise. When I think about, when we look at projects, first one is, high purity alumina. How many experts are there in the world? Manganese, we've done a bit looking at manganese and, at different mines. You need to learn a lot about a lot of different sort of commodities, and you have to become, a relative expert in a relatively short amount of time, which is very difficult. So you have to one, know the commodities themselves, and two, you need to find people who know those commodities. And with the explosion of battery metals, there's only so many really astute people out there who can actually help you sort of build these projects, and they're spread fairly thinly across the group, into operations, and finding people to help review them and getting the right outcome is quite difficult. So it's a function of maturity of the market, and it's a function of both price and expertise particularly.
Brendan, thanks. Turning to Brad and Justin, following on from Brendan's point, in fact, he mentioned bulk commodities to begin with, and it strikes me, talking to both of you in the last couple of weeks, that manganese's great advantage as a battery mineral is that it is a bulk commodity with an obvious market and an established market, but it's also a slight disadvantage in that, in looking to go downstream, you're entering a market that isn't quite the same product. Is that when you're trying to finance a manganese sulfate or downstream product, for instance, is that a difficulty in talking to financiers that you're talking about a relatively new or nascent product mix that you need to present transparency, which perhaps isn't there, and depth of a market that isn't there? Brad?
Yeah, sure. I agree with the points that have just been made, and this is a different thing, a different product, a different market, a different business to what we're already doing. As I explained in my presentation, we think we have some advantages because we've got a long life feedstock there, but that feedstock has to be converted into the product that we're talking about, and that's a chemical infrastructure processing business. The issue here, I agree with what's just been said, is that these are very nascent markets. You can't look at the Chinese market today, look at the HPMSM price and take anything from that. It's actually an oversupplied market because the demand today is tiny. So I think that to your question, we all need to look out to markets that exist in 5 to 10 years' time, and we all have conviction around the growth there, but you'd be nuts to take market risk on that as an investor or as a financier to any of us. And so the job here is about wrapping that volume and price risk, and that requires offtakes and it requires government assistance as well. And the other part of it is, as was explained, in many of these endeavours, most of them maybe it's going to be cheaper to do it in China. So if governments around the world are serious about having domestic supply, or at least ex-China supply of materials as they say they are, then some of this financing assistance needs to go not just wrapping that market risk, but also combating what is a cost delta in most cases. I think the final piece is actually ultimate demand. It's not going to help any of this if we're all buying BYD cars, which are made in China, sourced with Chinese materials. So there's several levels here, mostly to do with the market side, some to do with competitiveness of cost structures as a matter of reality that need to be dealt with. But from our perspective, notwithstanding we've got a successful business in mining, this is going to be a standalone piece of work that we need to build as a new business, and we will be dealing with those discussions around HPMSM as a project and what is the market of that. So we are dealing with exactly the same issues as was just discussed.
Thanks, Brad. Justin, you're obviously a little bit, might be fair to say, further down the road than Jupiter are in investigating that market and committing to that market. What are your learnings from talking to financiers and potential strategic partners so far? Are they worried about that lack of transparency in pricing and product mix?
Yeah, and I think we're sort of living pretty much what the guys have been talking about. I think you got to probably throw something else in the mix, which is technology risk. A lot of the flow sheets that people are using are innovative and new, and perhaps there aren't 20 of the plants that you can point to around the world and give the bankers satisfaction that the technology is going to work when you turn it on. But I think the lack of pricing transparency is definitely a key issue. And I think, you know, it's sort of, our journey's been quite interesting because we were actually planning to build a facility in Malaysia, which was, we picked it because it was proximal to existing battery manufacturers, but also it has a low cost structure. So that was sort of our way of trying to compete on cost with the competitors in China. But what actually happened, we were sort of had good engagement with Stellantis and General Motors, who are currently our two signed up offtake and financing partners for the project. The IRA came into being, and then all of a sudden the attention pivoted to building refinery capacity in the US. And so we've then pivoted with them because that's what they needed to satisfy their obligations under the IRA to attract the subsidies, the consumer level subsidies that the IRA brings to the table. And there was also some OPEX tax breaks that came into play for us as well, which helped to bridge the gap in cost between a Malaysia setting and a US setting. So I think the last bit would be just on the pricing side. I think Brad sort of hit the nail on the head when he said offtakes. You need to establish price, entry into binding offtake agreements with counterparties who are credible, like OEMs, who you can build a price into the contract, so that from a financial modelling point of view, you can sort of substantiate your revenue side. And if it's not, you know, if you try and link it to something as ephemeral as a Chinese spot price for HPMSM, for example, you're dealing with all sorts of issues around different specifications, different points of pricing, all this sort of stuff, and it gets even murkier. So we just kind of said to the guys up front, we're not going to talk around a Chinese price. We need to define a price that's going to fit the business model for what the partnership needs, and that's how we kind of went about it. So we were able to kind of deal with that issue that way.
Thanks, Justin. Daniel, back to you. Justin's comments there around a Chinese price or a Chinese product spec makes me think of Linda's fantastic slide this morning about what will qualify for foreign-owned, foreign interest under the Inflation Reduction Act. is it going to be possible in the next 5 years with current structures of financing to be able to see operations get up and running in the US that qualify for the full consumer tax credit and indeed the full production tax credit?
Yeah, that's an interesting question. I wouldn't look in the next 5 years. And I think that's a couple of comments here, I guess touching on what all the gents have said, especially Brad and Justin in regards to the challenges of this financing, and this is what we're saying. It's also the length of time, right? So traditional financing is what, your 7 years return. And the challenge with this industry is that this is longer term. So, whilst we see incredible demand, and we saw this in the slide, and we've all been talking about it today, we can see the demand of these metals and minerals over the longer term. And to wrap, a bank's head around, okay, well, you're going to get that return in 10 to 12 years, it doesn't sit within their yield returns. So that's one challenge. I think your question on the US market, the China market, the IRA, I think it's challenging, and that's the biggest problem here. I guess I can answer it in the following way. Do we then start to see and we've seen this in other commodities and other markets, we start to see a separation in markets, right? And if you look at what the IRA, essentially what the intention is there is looking at, ESG and the sustainable supply chain for end consumers of a particular market with a different price structure than you would have, say, with the China structure in place. So I think from a financing perspective, we'll probably start to see that there'll be a separation of markets. So if you're, coming from a raw material supply chain within Australia, that's being processed in Southeast Asia, Korea and Japan, and ending up into into the US as an example, and you can define that entire mine, to gate process and supply chain, then from a financing perspective, under a price structure, which is providing you the tariffs and the benefits for that end market, that will be that could be something that could be financed separately to a more opaque sort of China price scenario where you've got to Justin's point, an offtake agreement between one supplier into a processor, and it's not quite as transparent as some of these other sort of liquid markets.
Thanks, Daniel. Brendan, you were reaching for the microphone then. Have you been able to do, as Deterra, focusing on the bulks and the battery minerals, have you been able to draw parallels between what's happening in, say, lithium or manganese or nickel or rare earths to what's previously gone in other commodities? Are we just assuming that this is a brand new sector that's going to go its own way, or can we look to history to see what else has happened?
Yeah, it's a good question. I think all commodities, the solution to high prices is high prices, and the solution to low prices is low prices. So I think they all have that in common, because that's why they call it a commodity. And the concept of bifurcation of price, which is effectively what you're talking about, it's a hard one, because in reality it hasn't happened in many places. It does happen on rare occasion. We try to think fundamentally, about the supply demand, and we try to get a position that we can get comfortable with, a conviction position for a commodity, and then try to find the assets that are placed well within those commodities. So which is pretty much, you think about the Pilbara, like Mining Area C, probably the thing I have in the world. Back in the day, it may as well have been on Mars, because it was so far inland that it was it was Mining Area A was Mount Goldsworthy, Mining Area B was Shea Gap, Mining Area C was so far in the future they called it Mining Area C. It was a long way out. So I think all these commodities have their day, and there are parallels to be drawn, and it is trying to pick and the best deposits are probably found by geologists in the 70s, because they are the ones that sit on the surface that are actually easy to find without having to use a lot of fancy techniques. So we do use those parallels. We try to sort of identify deposits that are better in the commodities we like, and we try to get conviction around the commodity. Then we try to find the assets that we like and the basins that we like that have the right appropriate risk-reward return.
That's interesting that you mentioned all of those sort of mining fundamentals as a discussion point. Brad and Justin, maybe you first, Justin, given that you've got offtake agreements. OEMs have expressed a lot of interest and have signed a lot of deals, many deals right throughout different commodities. How au fait are they with the mining sector, with a mining project development? As Daniel mentioned, development timelines and project timetables, and also with the inherent risk of a mining sector, of a mining project. Is there still a big education gap to go?
So I think it's getting better. So when we started talking to OEMs in 2022, Stellantis was the first one, and we were sort of talking to an industry that was so far from our industry that it was almost a different language, right? So they were kind of trying to treat us like spare wheel makers or engine block makers, or they sort of saw us in that light. So a lot of the legal constructs they wanted to put in the offtake agreements kind of really didn't take into account the unique properties of mining and the development timelines as you talk about. So I think we sort of spent a lot of effort on breaking down some of those language barriers, if that's the right word. And I think we kind of learned a lot about their industry and they learned about ours, and we gradually started to speak the same language, and we were able to consummate a deal in January 2023. And then we sort of turned our minds to GM and kind of had to repeat the dose, but we sort of were a little bit better educated in how to go about it. So I think it's definitely bridging two industries that have never touched each other before, and it's a learning curve for sure.
Brad, in your initial assessment of the market, do you find is going to be there?
Yeah, we're doing ongoing work in that regard. As we've said a couple of times, this is a market which is emerging, it's growing, the pace is going to change, the chemistries are going to change, the battery types are going to change. Part of our conviction is that manganese's benefit kind of endures across those chemistries and battery types, but until we have those offtakes in place, it's prudent to keep studying that market and making sure that that thesis continues to be proven. Our kind of miners are, rather OEMs are getting dragged down the supply chain, and that's particularly the case where there's real shortage. Part of what we're saying is we don't need or want you to invest in our mine. In fact, we don't need or want you to, would like you to invest in the processing facility, but what we really do need from you is to stand behind volume and price. I think that providing that is there for a period which is sufficient to underwrite a payback, which it is for the sorts of economics that Justin has talked about and that we're looking at as well. That for me is the key financing thing on a project basis. It would be nice to think that they're all prepared to put money in, but a lot of the OEMs and midstream guys that we've spoken to would prefer not to do that, and that is because they don't want to have to become expert in that. They don't want to take more capital investment to their procurement than they would ideally like to do. Some of them see that value conversion there and want to participate, and that's fine. But a lot of these guys, I think ultimately what they're looking to do is get the lowest risk, lowest cost procurement, and what we as developers need out of them actually is volume and price. The money will be there providing everyone's off risk with respect to volume and price, and that for me is the core of this thing. The money will come if the returns are there, and the returns need to, Justin made a great point, also reflect perceived technology risk and other things. This is a new business across the board, so done properly, it should be infrastructure like for initial off-take period, and you can put in limbs of finance wherever that comes from. That will ultimately look to what's most important here, which is market risk, volume and price, for a sufficiently long period, so we're not all sitting here worried about the market. It's a very prudent thing to be worried about in view of these markets not being here today. We're all shooting for something, me included, that we have conviction in, but it's pointless to try and predict the exact shape of that as it pertains to your project. You need to have customers who ultimately want this material standing behind that, the revenue of the project for an off-take period.
Thanks, Brad. But Daniel, would you agree with that sentiment? And also as a follow-up, it strikes me, in more traditional metals markets, the one area that's missing in these emerging technologies, is the traders and the smelters that are such a big part of base metals or other commodities like that.
Absolutely, and I think that, I think what we need to be aware about in this particular industry, call it that, this is a chemical process, right? Touching on Justin's point, you're going through brand new technology challenges. So it's not to a degree, your typical commodity market where, it's bulk commodities, you're pulling coal out of the ground, you're putting that, into a power plant as an example. This is very different. And I think right across the industry, that's a very challenging part of the process you're right, it doesn't have the same sort of structure as you do with the aluminium industry or the steel industry. I think even to Brendan's point, from a royalty perspective or a financing perspective, there's so many unknowns, and it's a technology industry, and I think that's the biggest challenge that it has. And so when you're running things like value in use adjustments and those types of things, that traditional type of approach sometimes doesn't work, and I think that's the big problem that the industry is facing, and that becomes a challenge both for the OEMs from an education perspective, as Justin touched on. I think they're getting better there. I think they're trying to really work alongside, the designers to understand what those processes really are and what they're really getting into, because they're car manufacturers, as an example. So, I think that, from our experience in CRU, we see that the Australian, miners are taking the forefront there in that education process into those large OEMs, and really trying to educate them around this sort of technology challenge, that we're seeing. And we're seeing, a lot of, different products, whether it be sulfate or lithium or so on, that, is having challenges. And when you see the volatility in that market, as we're seeing, it raises eyebrows, and, it makes that sort of traditional financing a little bit more, challenging in that.
Yeah, I assume, and Brad and Justin, you'll be able to explain better, but it's as Daniel says, it's a chemical product that you're producing, 549s or whatever. It's not producing a concentrate that receives a couple of discounted treatment charges for a couple of impurities. You have to hit spec every single time, which complicates the matter. I've asked plenty of questions now. I think it's time for you guys to do some work. We have a question right up the front from our esteemed session chair. Taylor's just charging towards you now.
Walk a long way. Hello, and thanks again for offering up your thoughts on this very challenging space. Brad, you mentioned government support, so I have two questions. I'll give them both to you. You can answer them in your own time. You mentioned government support playing a role in supporting this process going forwards, and I think that's probably quite a broad question. What might that look like, and how likely do you think that is? The second question relates to the opacity of pricing, which is obviously enormously challenging in terms of financing, but also in terms of the competitive market against China. That's how they leverage a lot of control against non-Chinese operators. Is there a place for what my perception of the platform that Pilbara Minerals built, that auction platform, is there a place for that sort of initiative where they seem to be able to pull back the curtain on pricing by making it public and making a bunch of Chinese off-takers actually compete in a public domain so that the pricing was made public? Is there a space for more of that sort of initiative?
Brad, did you want to take that on first?
Sure. I think Justin mentioned the IRA framework in the US. I think that's closest to what we're talking about, and we've, through the course of our scoping study, literally boiled the world for sort of markets of where makes most sense in order to put our processing facility, and came to the same conclusion that Justin did, in large part because of the incentivisation framework there. So I do think it needs both sides. There needs to be incentivisation, consumer demand for products that are made in the local market, because at the end of the day you can incentivise the supply battery-grade materials and batteries to be made in North America, for example. But if everyone's importing Chinese cars, then you've just undermined the demand side of the equation. So the incentivisation for people to buy electric vehicles that are made locally is an important part of this, and there are those frameworks in North America and elsewhere, and they need to remain. And that goes partly to price competition on the overall vehicle, but also just not undermining the demand, because there may be, and there have been in vehicles naturally, a trend towards lowest cost, and that could lead you down a path where you don't have any local demand and everything else is for nothing. You then need incentivisation, and they can be CapEx and or OpEx subsidisation. And also land permitting, all those sorts of things are in place in North America. So other jurisdictions in the world are trying to do those things to mirror some or all of those, but the actual legislative framework is best in place and operating in North America. So I think I'd point to that. But yeah, the real point for me is there needs to be both sides. There needs to be support for the development of the supply side that is ex-China, because if you look at manganese, it's all Chinese right now, demand and supply, and so you're looking to make new markets on the supply side, but you also need to think about the demand side until that's all up and running. I think that answered the first part of your question. I'm happy to answer any other parts or give someone else a go.
Did anybody else want to have a go at the second part of more transparency? And it was interesting, Philip, you made this comment. I was in Cape Town for the Manning in Darborough, and there was a graphite panel, and each of the graphite executives that were on the panel, they were given, if there was one thing that they could see in the next 12 months for the graphite market, and it was some relevant pricing and spec structure that they could point to in a presentation, I assume. Daniel, you were going to...
Yeah, look, it can be done, of course, and it can be done with the cooperation of, you know, the miners that are selling the product, and then to your point around Pilbara being transparent in regards to what those contract prices are. So there's no two ways about it. The transparency of the market can be opened up if there's a willingness to do that. And I suppose that's got to be on both sides, on the China side as well. Sorry, you want to...
Yeah, you talk about the analogy to iron ore and coal. Both of those had very, producer to customer sort of markets for majority of their life, and they only opened up when people created standard specs and a standard framework to sort of go up and down from that spec based on impurities in the output. So I think it's possible. I think it's happened in other commodities, and it's just a natural evolution with maturity.
Great, thanks. Well, we've got time for one more question. Has anybody got a burning question or a comment? Just leaving the work to me, I see. Thank you very much. Well, in fact, in actual fact, we're counting down. The red light is flashing on us, gents. Did anybody else want to add anything more? Justin, did you want to add to that point around spec and transparency in a separate, in a definitive product environment?
Look, I think it's definitely real. I mean, we've got a deck of about 20 specs that we've accumulated from different corners of the world, and lack of standardisation is definitely part of the problem. I think I'm not sure exactly how you solve it, because different PCAM manufacturers have different requirements. So I think there's more work to do on that, but it'd be lovely to see more transparency and more standardisation. I'm sure it'll come as the market develops.
Brilliant. Thank you very much, gentlemen. Thank you very much. Can you just join me in thanking our speakers this afternoon? Again, that's the third panel today where I've had to say that we could have gone on for another hour, but there's morning tea, and I'm hoping it's scones and cream this afternoon. Thank you very much again to everybody who spoke in this session, and to Philippa, our session chair. Afternoon tea is served outside, sponsored by Rystad Energy. We just heard Susan speak earlier on today. So thank you very much, and we'll see you for the next session.